This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Monday, June 29, 2026, and this is the New York session. Now, let's get into it. The Fear and Greed Index has collapsed to a staggering 14 out of 100, marking a 7-day trend rise from 12, signaling maximum investor capitulation. Yet, in a stark divergence, gold is falling over 1% to $4,065.89, and the US dollar is absorbing all available liquidity. We are live in the New York session on June 29, 2026, where safe haven demand is being ignored in favor of dollar liquidity, creating a fragile equilibrium that threatens to snap at the first sign of data surprise. Looking ahead to the next 48 hours, the calendar is heavy with U.S. labor data that will test this fragile dollar dominance. On Wednesday, July 1st, the ADP employment report and the GDP now estimate drop, setting the stage for the critical non-farm payrolls data on Thursday, July 2nd. With the Fed funds rate holding at 3.63% and core PCE stuck at 3.41%, any upside surprise in these employment figures will likely reinforce hawkish expectations and squeeze the yen further. Apex, what is the key risk here as we approach these releases?
The key risk is that the market has already priced in a hold and watch stance, but the positioning is so skewed that a single data point could trigger a mechanical unwind. With leveraged funds holding a net short yen position of minus 97,092 contracts, the market is essentially a loaded spring waiting for a catalyst to force covering.
Let's break down the current market structure. The trade-weighted dollar index rose 1.01% week over week to 120.40, while the VIX sits suppressed at 18.41 despite the extreme fear reading of 14. We have a decoupling of sentiment from volatility. Pulse, walk us through the macro forces driving this dollar strength despite the panic. The market is trapped in a stagflation-light paradox. You have extreme fear at 14 out of 100, yet the Fed funds rate remains rigidly elevated at 3.63%. Core PCE is at 3.41% and CPI at 4.17%, both significantly above the 2% target. This removes any near-term catalyst for rate cuts. The 10-year, 2-year yield curve is flat at plus 0.31%, with the 10-year at 4.40% and the 2-year at 4.09%. This flatness, combined with real GDP slowing to 2.09%, creates a policy environment where the Fed must hold rates high to combat inflation, sustaining DXY strength despite the panic.
I have to challenge Pulse on the assumption that euro-dollar support at 1.13247 is robust. The combination of a flat yield curve and sticky 3.41% core PCE suggests that any technical bounce near the current 1.13844 level is likely a liquidity trap. The fundamental macro backdrop favors continued dollar appreciation over a technical recovery. We are seeing euro-dollar consolidate beneath 1.14340, which acts as a hard cap on the current 5-day range.
And that is precisely why this setup is dangerous. The VIX is suppressed at 18.41, sitting near the lower bound of its 5-day range between 16.49 and 20.72. This indicates that options markets are not pricing in the severity of the 14 out of 100 fear score. We are seeing a dangerous decoupling between sentiment and implied volatility. The extreme fear is being masked by dollar liquidity absorption, rather than genuine volatility expansion, creating a fragile baseline for a sudden regime shift.
So we have macro support for the dollar, but let's look at the headlines actually moving the market today. We are seeing mixed signals. First, dollar is mixed as FX traders await the next breakout. Second, intervention fears are capping the dollar-yen upside as traders await the key US data. And third, Deutsche says to fade any dollar strength going into month-end. CIPHER, how does this headline activity translate into actual flow?
The headlines reflect the positioning reality. Leveraged funds are strongly bearish on the Japanese yen, holding a net position of minus 97,092 contracts, with a week-over-week change of minus 98,892. This is one of the most crowded trades in the current COT report. However, Deutsche's note to fade dollar strength is a contrary take that ignores the COT data. The flow data shows capital is flowing out of European assets into the dollar, with leveraged funds moderately bearish on euro with a net position of minus 15,410 contracts, a week-over-week change of minus 13,103. The flow is not fading, it is consolidating.
Let's go deeper into the specific pairs. First up is dollar-yen. It is currently at 161.7945, minus 0.00%, approaching its 5-day high of 161.950. Grid, map the technicals for us.
Price action is compressing into this critical 5-day resistance node. Current price at 161.7945 sits just 15 pips below the 5-day high of 161.950. This level has acted as a hard cap on the current 5-day range, which has a low of 161.532. We have seen repeated rejection at this specific technical level, failing to sustain breaks above the 5-day highs. The data indicates a wait-and-see structure where liquidity is thin.
But grid, you are looking at a technical barrier that ignores the structural fragility. The minus 97,092 contract short imbalance transforms the 161.950 level into a liquidity trap. A break above this level will likely be accompanied by forced covering rather than organic buying. The COT data reveals that the squeeze narrative is not fading, it is building. The massive yen short position makes dollar-yen vulnerable to upside spikes due to the extreme crowding of yen shorts.
And SPECTER adds that given the minus 97,092 net short yen position and the VIX suppression at 18.41, this level is not a floor but a trigger for a liquidity vacuum. The technical resistance is irrelevant against the momentum of a forced short squeeze fueled by the flat yield curve and hawkish Fed funds rate. If the VIX breaks above its 5-day high of 20.72, this setup could unravel violently.
Moving to euro-dollar. It is at 1.13844, minus 0.01%, trading near its 5-day high of 1.14340. Pulse, does the macro support a break here? No, the macro supports dollar strength. The 10-year 2-year spread is flat at plus 0.31%, and core PCE remains at 3.41%. The labor market is resilient with non-farm payrolls at 159,000.1 with a plus 172,000 month-over-month change. This provides the necessary data to justify the current 3.63% rate level. There is no fundamental reason for euro-dollar to break out. The fundamental backdrop favors continued dollar appreciation.
Technically, the pair is trading at 1.13844, effectively sandwiched between the 5-day low of 1.13247 and the 5-day high of 1.14340. This indicates a lack of directional conviction. Momentum is currently neutral to bearish on the short-term horizon. A failure to hold the 5-day high will likely trigger a reversion toward the 5-day low of 1.13247.
Let's look at the anomaly in the commodity space. Aussie dollar is at 0.688890, minus 0.10%. CIPHER, why is this pair bucking the risk-off trend?
This is the key anomaly. In stark contrast to the risk-off environment, leveraged funds are strongly bullish on Aussie, with a net long of plus 39,111 contracts. This is an outlier that suggests institutional positioning is decoupling from the broader dollar dominance, where the DXY net position is plus 4,438. While the market is fearful, smart money is front-running a potential liquidity shift away from the dollar-yen pair and into Aussie. This creates a potential uncovered opportunity for a squeeze if risk assets stabilize.
But be careful, CIPHER. This bullish positioning on Aussie is happening while the broader market is in extreme fear. The VIX is suppressed at 18.41, and gold is falling to $4,065.89. If the risk-off sentiment deepens, This Aussie long position could be the first to get liquidated. The divergence between the Fear and Greed Index at 14 and the VIX at 18.41 suggests that implied volatility has not yet priced in the severity of the crash. A sharp expansion in volatility could wipe out these longs.
Let's talk about gold. It is at 4,065.89, plus 0.07% intraday, but down over 1% from prior close context. The 24-hour range is 3,959.01 to 4,112.20. Pulse: why is gold falling despite the fear? Gold is falling because dollar liquidity is being prioritized over traditional safe havens. The Fear and Greed Index is at 14, yet gold is down over 1% to $4,065.89. This indicates that capital is flowing into dollar liquidity rather than precious metals. The market is pricing in a higher for longer rate environment that hurts gold. Given the sticky core PCE at 3.41%, the safe haven demand is being absorbed by the dollar, not gold.
Technically, gold's 5-day low of 3,959.01 and high of 4,112.20 highlight extreme intraday swings. Yet price remains anchored near the midpoint at $4,065.89. This reflects the extreme fear sentiment without a clear trend breakout. We are seeing a compression in volatility that often precedes a larger move.
SPECTER, you mentioned earlier that the VIX suppression is a risk signal. What happens if that suppression breaks?
If the VIX breaks above 20.72, the current dollar liquidity rally will likely reverse into a disorderly equity correction. The gap between the Fear and Greed score of 14 and the VIX of 18.41 indicates that, while sentiment is panicked, implied volatility has not yet spiked. This leaves room for a sharp VIX expansion if data disappoints. The current setup favors a violent repricing event, where the VIX snaps back toward the upper end of its 5-day range, as the dollar dominance masks underlying equity stress.
Apex bring this together. We have dollar strength supported by macro data, but extreme positioning in yen shorts and an Aussie anomaly. How do we navigate this session?
The current market structure is defined by a violent decoupling of sentiment from liquidity. While the Fear and Greed Index has collapsed to 14, the dollar is absorbing all available liquidity, driving the trade-weighted dollar index to 120.40. Grid flagged the technical resistance at 161.950 in dollar yen, but CIPHER showed that the minus 97,092 contract short imbalance transforms that level into a liquidity trap. SPECTER warned that the VIX suppression at 18.41 is a ticking time bomb. The synthesis here is that the market is fragile. Any hawkish data surprise on Wednesday or Thursday could trigger a mechanical unwind that accelerates dollar strength across all crosses, particularly dollar yen, while Aussie remains an outlier waiting for risk sentiment to clarify.
Key takeaways for the New York session. First, the macro backdrop of sticky core PCE at 3.41% and a flat yield curve supports dollar dominance despite extreme fear. Second, dollar yen is approaching a critical technical and structural inflection point at 161.950, with massive yen shorts creating squeeze risk. Third, Aussie is showing anomalous bullish positioning that contradicts the broader risk-off regime, but remains vulnerable to volatility expansion. And fourth, gold is diverging from safe haven flows, falling as dollar liquidity absorption takes priority. Watch the ADP and non-farm payrolls data this week closely, as they will determine if this dollar rally holds or reverses. This is ShadowQuant Forex edition. Stay vigilant. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Forex edition. Stay tuned for the after-hours session where we will see how these calls play out. Until then, trade safe.